Hello and welcome to another episode of The Future Off. I'm your host, Azam Faruqi. Hi, Vasi. How are you?
Good. How are you?
Not
How's
too
everything?
bad. How's
Yes.
Greece treating you?
Excellent. I'm here as I was mentioning to you earlier, post-election in Greece, and one of the things they have noted here is how a lot of the polling got a lot of the election coverage or voting wrong, and so I know one of our more popular podcast episodes was on the future of polling, and so maybe there's something there not only within the context of Canada that we had the discussion, but also globally. So that's been kind of interesting. Yeah.
Yeah, it's interesting. It's becoming par for the course now. Pollsters getting things wrong. But today we have a very exciting guest. We have Mark Higgins with us. He's the author of an interesting book that's coming up in February 2024, Investing in U.S. Financial History. Mark has also worked as a financial advisor in the past, and we're really looking forward to this conversation. So, thank you for coming to our podcast, Mark.
Thank you for having me. I'm excited to talk about
Yeah. And,
financial history.
yeah. And Mark, I know you're based out of Portland, Oregon.
Correct.
So we're all over the place right
Yeah,
now
we pretty
in
much
the
have
world.
globe covered
We're,
at this point.
I think we're representative of three countries. So
That's
there you
right.
go. So maybe to start off, Mark, I find the concept of your book really fascinating. I know we haven't been able to read it, but
Yeah.
it is coming out, so our listeners know, in February of 2024. And I really wanted to start off to find out from you, given your background, how did you come up with the concept to say, I'm going to look at U.S. financial history, write a book about it, and write a book about it in the context of investing?
So prior to I left my career as a investment advisor for large institutional investors like pension funds and foundations and endowments in March 2022 to finish the book. But where the idea came from is actually when COVID hit in March 2020. Suddenly we're in quarantine, we can't do anything, and I started read. I've always been a big reader, so I started reading about financial history. And the more books I read, the more I realized that this was actually a lot more helpful in advising clients than just kind of paying attention to what is happening in the daily news. So, I don't know when it kind of hit me, but after reading, I don't know, call it 15, 20 books or something like that, I just was surprised that there was no book that really walked through the entire financial history of the United States. I thought it was something that was needed. I know it was really ambitious to kind of write a book that goes from 1790, which is when it starts with Alexander Hamilton's
Oh,
program,
wow.
to today. But I thought I would take a shot and started writing the book. Finished it. I actually just finished the manuscript about 2 months ago. I got a publisher about a little less than a year ago, and yeah, so that's what I saw, a huge gap in the market. I knew it was actually more helpful than just kind of watching the daily news and basing investment decisions on life experience. So I tried to fill the gap, and that's where it came from.
Yeah. And Mark, would you say like the crux or the thesis of the book is really about how we need to look at what that financial history looks like in the US to make sense of, how we invest and sort of maybe
Yeah.
where the markets are going as well?
Yeah, I mean, it's less about predicting where the markets are going to go in the next 6 months to a year. I honestly believe that's next to impossible. It's just to do that is to really claim that you understand what's going to happen that in a way that's not possible. You just can't understand how people are going to react as a group. You can't understand little shocks that might come up. It's just impossible to do. But what I have found is that most people, including me, before and still to some extent, base their investment decisions on what they've experienced in their lifetime and what's been happening recently. And the reality is that not a good match for how financial markets and economies work. The big underlying currents often play out over decades, even centuries. And people miss that because they're so focused on what the noise that's happening in the present. And that's, if there's one big lesson, it's that from the book, that when you understand how the US has evolved over 230 years, you start seeing big patterns and big currents that just aren't visible over a single lifetime or, a few years.
And that's something very interesting you mentioned,
Mm.
because if I put myself, I came out of university a couple of years later, the financial crisis hit, right?
Mm-hmm.
And so that was one defining moment. But the other piece is a very long period of low inflation, right?
Mm-hmm.
And a lot of times we even had a lot of macroeconomists talking about, no one's sure why inflation isn't ticking higher, because we had a lot of quantitative easing.
Mm-hmm.
Stock markets had been doing, like, there were a lot of um, like, for 10, 15 years people were used to very low inflationary environment, right? At least a decade.
Mm-hmm.
And suddenly now inflation hits, and this is something new for an entire generation. So this is one of the things I'm hoping to explore as one of the 3 or 4 main themes today. So if we talk a little bit about inflation, are there any lessons from the U.S. Financial history that can help?
So, I mean, this is the perfect, and the timing of this was, I mean, it's not good talking about COVID, but it really was a perfect example of why it's important to understand financial history well beyond what people usually, what investors usually study. With what got missed, there are a couple things that got missed with inflation, and I think the Fed missed it, to be honest with you. When COVID hit, it wasn't like anything that we've experienced in the recent past, but there are precedents that are actually pretty similar. And the most interesting comparable, I thought, and I've written about this, is the inflation that followed the end of World War One and the Great Influenza, which was the last major pandemic in 1919. And it was really a very similar dynamic. You had a lot of monetary and fiscal stimulus in the form of war spending prior to the end of World War One and the Great Influenza. You had a lot of pent up consumer demand because people were locked in their houses during quarantine and people were rationing. And then when it ended, it all got unleashed. And the same thing happened. You had this huge spike in inflation in 1919. The Fed was very aggressive in tightening policy, and everything went off a cliff in 1921. And really, the same thing happened in the post-COVID environment for very similar reasons. And people missed that. And then, people also missed. So, to your point, people are very used to living in a very low inflation environment. And when this inflation hit and the Fed started signaling in early 2022, look, we're gonna tighten policy and we're not gonna stop. A lot of people didn't believe it because they were so dovish for the past 40 years, but they didn't understand that the circumstances allowed that. And what was really shaping the Fed at that point, and you can see it in their minutes, you can see it in their speeches, is there's this article that circulates the Fed. It's called "The Anguish of Central Banking." It's from a speech that Arthur Burns did in October, I think it was October, maybe September 1979, where he basically outlined all of the mistakes they made in the late 1960s, which led to the 1970s inflation. And the Fed leadership is very well aware of that. And when they saw inflation persisting for a year, they knew they had to stop it. They could not stop tightening, regardless of whether there's a recession. They could not stop tightening until they stop it, or that it sets in and you have another stagflation event like the 1970s. So people miss that because they were so used to the Fed being dovish, and they didn't appreciate that the conditions warranted that dovishness. It was not ideological, it was circumstantial, and that shifted in 2022. Now, if you knew the history, it wouldn't have been as surprising.
Fascinating. And I don't know if you can, or you might, like, I mean, you can't put yourself in others' shoes, but why do you think? I can understand, okay, people missing it.
Mhm.
Obviously, they've never gone through an event, right? a lot of times no one really thinks they're going to go through like a black swan event in their life, like
Yeah.
but why do you think policymakers miss that? Just like lack of awareness of financial history?
Awareness.
We always
I,
think
yeah.
that's something different.
Well, I think I don't think they missed the late 1960s. The Fed is, by early 2022, they knew they had a big problem on their hand, and they started signaling that they weren't going to stop. And now I think some people didn't believe them. But if you understand the late 1960s and what happened in the 70s, you know, I believed them. You know, like they're aware of that, and they just had no choice. They had to tighten, or once expectations start getting elevated on inflation, it gets really hard to stop. Now, the 1919 event, I just think it's so distant in the past that that a lot of people just weren't aware of it.
So let's talk a little bit. Sorry, Beth, you had a
And the
question?
other thing, the one thing
Yeah.
I will add is people, and this is something I've developed a deeper appreciation for reading. People assume that things that happened 100 years ago aren't relevant. And the reality is they're actually more relevant than people think. Technologies change, economies change, but at the end of the day, people don't change. Human behavior doesn't change all that much. And a lot of things that
Yes.
happened 200 years ago, 100 years ago are more relevant than people think.
And we learned that with COVID.
Yeah. Yeah.
Similar to the Spanish flu,
Yeah.
right? Which
Yeah.
would have been like the last, I guess, in recent memory, sort of catastrophic health global crisis that impacted so many people. I
Yeah.
guess my question around inflation, maybe it's more future looking than it is backward looking. So we know the Feds have sort of, we've got an inflationary issue in the US. It's actually a global issue now.
Mhm.
And because of it, on top of most citizens being used to low inflationary rates, we're also we're used to low debt, right? So access to borrowing, low rates, and the way to sort of, what I'm understanding is, to stem inflation, that's where the economic policy is shifting and they're increasing interest rates and tightening here and tightening there. Like, do you foresee that, given we've had this 10, 12-year era, what I would say is prosperity for a lot of people, that now that changing, like, do you think what they're doing, and maybe you can look at what's happened historically, this is part of the course correction and we'll maybe get back to where inflation is a bit more manageable, rates come down and things are much more affordable? Because affordability right now is I don't know how a lot of people are surviving. It's quite high,
Yeah.
especially when you look at things like food inflation and housing and so forth. So.
Yeah. I mean, I do think that's a pretty general question, but I do think that the Fed's going to win the battle with inflation because they're not going to stop until they do. And I definitely fall in the Milton Friedman camp of inflation is a monetary issue, and if the Fed tightens policy enough and raises interest rates and reduces the money supply, it will reverse. And I think you're starting to see that. There's, I wrote an article for the CFA Institute. I forget the title of it, but there's a great. I went on a trip to London in July 2022, and I'm a nerd on financial history, so I go to the Bank of England Museum with my son, and there's this exhibit called the Inflation Game, where they have this like air tube with a ball in it, and you have to balance it at the 2% target. And it's kind of easy if you start with it around the 2% target, and then you hit this button that is a financial shock, and it knocks the ball in one direction. And what ends up happening is a great analogy. What ends up happening is to get it back to the 2%, you go too far in the other direction. It kind of goes. It's price instability, so it goes back and forth. And the reason I've definitely been in the camp that a recession is the most likely outcome eventually, and it's for that reason. Inflation is high inflation is one end of the spectrum of price instability, and when that happens, it's really hard to just kind of slowly reduce it back to 2%. You're usually going to go in the other direction for a little while. That's what happened in 1921. It's what happened in 1982. You had a deep recession. I think it's probably going to happen today, even if regardless of what the data says, that's just the fundamental dynamic says that that's probably going to happen. Now, if it doesn't, the Fed deserves a lot of credit because the odds are not in their favor.
So what are the odds that are not in their favor? Sorry, I don't want to press too much on this topic. We want to cover a few other things as well. One, like when you say odds, like one thing I always look at least here in Canada, we see that in US as well, the fiscal policy is still quite expansionary.
Mm-hmm.
How does the Fed balance a tightening?
Sometimes they fight each other. That was one of the problems with the 1970s and the late 1960s is the Fed, first of all, they got a lot of political pressure from President Johnson and Nixon, but there was this kind of implicit belief that fiscal and monetary policy should be aligned. So when Great Society related spending and Vietnam related spending went up, the Fed thought they had to be kind of accommodative as well. So that fueled inflation. But, unfortunately, sometimes the Fed is kind of fighting against fiscal policy. If fiscal policy is too expansive, like it was in the stimulus, like the stimulus definitely was. Now, you didn't know that at the time. It's hard. It's kind of hard to predict that. And we were in a crisis. So it's kind of hard to blame the federal government for going too far. But, the Fed, people aren't going to raise taxes and take back the stimulus. So the Fed has to offset that. I think we're in a period right now where in the United States that fiscal policy went too far and the Fed is now having to compensate for that.
Awesome. So let's segue into another theme that I think it's important to discuss today is the monetary policy. Speaking of Fed, now it's not huge, but we're starting to see over the last couple of years with the rise of cryptocurrency,
Mm-hmm.
and in general as well, there has been a bit of a lack of trust in our monetary policy the way it has been in the past few years. Whether
Bitcoin started in 2008. I don't think that's a coincidence.
True.
Yeah.
Especially with the rise of all these cryptocurrencies, obviously a lot of them have crashed since then. But if we go back and look at the Bretton Woods Agreement, how can an understanding of monetary framework help us evaluate what the current global financial landscape is and what are potential future developments in international?
Yeah. So Bretton Woods. I read
and wait, and maybe for our listeners, if we can explain what Bretton Woods is as well.
Yeah. So Bretton Woods was essentially after World War II. There's a lot of reasons for it. I'm not going to get into all the details. I do have a chapter on it. But it essentially set a fixed rate exchange rate system for, I think there were like 35. There were a lot of countries. I forget the actual number. And then it was tied to gold. And the problem with Bretton Woods, it was actually fundamentally flawed from the beginning, because you had a situation where the U.S. was currencies were pegged to the dollar and the dollar was pegged to gold. But because foreign countries needed to hold reserves in dollars, you had a situation where eventually there'd be more printed dollars because the central banks needed to hold reserves than the underlying gold. And once the central banks figured that out, which they did eventually, there would be a run on gold and there wouldn't be enough gold to cover it. And it's called the Triffin dilemma, if you look it up. And it was predicted by, I think his name was Robert Triffin, who's an economist. And his last name was Triffin. I don't know if his first name was Robert. You may need to fact check that. And so that eventually happened. In 1971, the U.S. delinked from gold and, became a fiat currency. So, but, with regard to cryptocurrency, I don't know if the Bretton Woods is really the way to think about it. What's interesting to me, I do think it's reflective of people who have lost faith in central banks, which I think is misguided, to be honest with you, but that's another issue. But the more interesting thing with cryptocurrency is, from a financial history perspective, is it seems very similar to what was going on in the 1800s. So people don't realize that that the way currencies worked in the United States, the way the U.S. dollar worked in the United States in the 1800s is not the way it worked today when there was no central bank. So the dollar was it was the currency of the United States, but it was backed by, it was called specie, usually gold or silver, and banks would issue notes, and every bank would have their own notes. So like if you had a banknote denominated in a dollar, it wasn't necessarily worth a dollar. It was worth, it could be worth 80 cents on the dollar, it could be worth 20 cents on the dollar. It was basically just, thousands of different currencies. And to me, crypto is actually a lot like that, that you have these different forms of currency, and there are a lot of disadvantages to that, and I see that repeating. And the United States has gone through. Whoa, sorry, I almost lost you. The United States has gone through periods where you have different currencies circulating around, and there are a lot of disadvantages to that. And I don't know if the people in the crypto community appreciate that. I don't know if that answers your question. I just, the Bretton Woods Agreement, it didn't work because it was fundamentally flawed. I don't know if I see that as the comparable to focus on for crypto.
Makes sense. Yeah.
That's fair. And the reason, and it's interesting that you mentioned, and again, it's such an overarching theme that not understanding your history has such interesting ramifications, that the entire rise of cryptocurrency, people forget that Fed was created early 1900s or something, right? Sometimes in the 1900s.
Yeah, so I think you had a question prior to the call on the Panic of 1907. That was really the event that made the U.S. Congress, the politicians were very opposed to a central bank for about 75 years. And that was really the event that finally got enough people to realize that central bank was necessary. And the Federal Reserve Act of 1913 was the result.
So it's great that you mentioned, because that's something that we were going to ask about. So why don't you talk a little bit about Panic of 1907? It's something that's I've been interested in looking at some of the events in the past. So you can just talk a little bit about the panic itself, what happened, and how does it relate to today once again?
Yeah, so the Panic of 1907 is honestly one of the more important events in U.S. financial history. And it was the last major panic that got enough momentum for the U.S. to return to a central banking system. A lot of people don't realize that the U.S. actually did have two iterations of central banks before. Alexander Hamilton established one in 1791, had a 20-year charter, ended in 1811, huge mess, comes back in 1816. Andrew Jackson kills it in the 1830s, and then we didn't have a central bank until 1913. And there are a lot of the chapter is pretty extensive, and there's a lot of important lessons from the Panic of 1907. But essentially what happened was you had an earthquake in San Francisco in 1906. And there was a huge amount of money required for reconstruction. So a lot of money, which was usually stored in New York, was pulled out. And that created a lot of strain on the system. And then what you had to happen every year, it was like clockwork. You had this thing called the agricultural financing cycle, where farmers would need money to transport their crops to market. So they would pull out of the money from what were called country banks, and the country banks would pull it out of New York. And you basically have a liquidity crisis or liquidity pressure every fall. So the combination of the earthquake and the agricultural financing cycle caused a huge draw on capital from New York in the fall of 1907. Then you had this novice Wall Street broker called his name was Otto Hines, tried to corner the stock of United Copper. It failed, and that triggered the panic. But some of the lessons from the panic first of all, I think the most important lesson is just the danger of shadow banking. So you had another thing going on in New York at the time, which is they're called trust companies, the basically lightly regulated state chartered banks that were proliferating, and they were almost as big as the national banking system. And they were lightly regulated. They had a fraction of the reserve requirements of national banks. They didn't have investment constraints. So they were much more vulnerable to a run. And the panic of 1907 is relevant to today because it reveals the danger of a shadow banking system. And that was really the problem in 2008. It wasn't the commercial banking system that was a problem, although that did become a problem at the end. It was the investment banks, which were not under the umbrella of the Fed. It was AIG, which was doing stuff that they shouldn't have done. So that was an important lesson, just revealing the dangers of an unregulated shadow banking system. And then the last thing is just the importance of having a lender of last resort. That's what was revealed in the panic of 1907. A lot of people think that the public in particular, they misinterpret what the Fed is doing when they provide capital to banks. What you essentially have in a fractional reserve banking system is periodically you will have banks take deposits and they invest it in long-term assets. And if everyone tries to withdraw their money at once, they can't sell those assets, and even if they're sound. So what a central bank does as a lender of last resort is when a bank is fundamentally sound, but everyone's trying to get their money out, what they do is they take assets off the balance sheet, give them cash to satisfy and calm the depositors. Then when things calm down, people redeposit the money, the assets go back. So that's not a bailout. It's basically, they called it in 1907 currency inelasticity. It's enabling banks to manage periodic draws on their capital that don't necessarily threaten their solvency. It's just a liquidity issue. So that was the big lesson of the panic of 1907. That's why the Fed was created, and that's probably a lot more than I should have talked about, but those are some important lessons from the panic of 1907.
So the question I actually had, and maybe it builds upon the panic of 1907, is you do on your blog write a lot about how long-term thinking is important when it comes to sort of investing and short-term market fluctuations. And we're sort of in that situation right now where people are like, what's going on? Markets are changing, there's a lot of fluctuations and so forth. So could you maybe elaborate on how the research that you've done and the historical perspectives that you have in US financial history can maybe help guide us as individuals to maintain a more disciplined approach to investing? Or what would be your advice to somebody who's living right now within the current sort of market fluctuations and all the changes and so forth?
It's kind of a dual message. We have real problems today. It's not that they're not real, but what I used to take weekends and read newspapers from like 150 years ago, and around major events. And what you realize by doing that is every generation thinks that they're the last one.
Right.
Every generation. It's not that we don't have real problems. We do. But human beings are pretty innovative and resourceful, and we do work through them. Now, one day we won't. Sometime between 0 and 1 billion years, the United States isn't going to be here anymore. But the odds are, whatever problems we're dealing with right now, we will get through. And we've seen worse. I write at the end in the book. We've seen some really bad times in the United States. The American Civil War, the World War I, the Great Influenza, World War II, the Great Depression. We've seen really bad times, and we do get through it. But it requires pain and sacrifice, and that's gonna. It's sort of depressing to see that, but it's also gives me optimism knowing that we have very real problems today. I'm more optimistic than most that we will work through it. That does not mean it won't be painful, and that it won't require sacrifice, but I do think we'll get through it. And I think by learning, by really immersing yourself in financial history or just history in general, you start to appreciate that things look less dire than they do if you just kind of limit yourself to your own life experience.
That's very insightful.
Does that answer your question? Or
Yeah.
Okay.
Yeah. No, and I think to expand upon that, it's sort of nothing is short term. There's always a cycle of ebb and flow with everything in society, and for us, you have to be really focused on everything's the long game, I guess. Like, it sounds really cliched, but it's really focusing on what you need to focus on to make it long term, as opposed to, oh, I need to panic. What do I need to do in the short term? This is changing.
Yeah.
This is changing.
Yeah, I mean, that more than it does give. Doing all this research has given me more of a calm reaction to what's happening in the world, because there's comfort in seeing the same things happen before, and that does not mean there's not going to be pain as a result.
Right.
There is comfort in seeing that things do work out. It may take more time than you think, and things are usually not as good as you think they are, nor are they usually as bad as they are if you have enough of a time frame to think about. I don't know if that's the best way to put it, but it does make it easier to tolerate what looks like financial catastrophes when you've seen them before.
Yeah, that's
No,
fair.
absolutely. I think it probably applies, I think, as you mentioned, to almost any aspect of life, right? Whether we're looking at geopolitics or in general. I mean, if you zoom out, you're a very tiny, like your life experience is a very tiny dot
Exactly.
in human history, right? So,
Yeah. And I think we always underestimate the resiliency of
Yes,
humans and
absolutely.
society. Because I felt that also during COVID. People were like, it's the end of the world. And I look, the world is still here. Right.
Yeah.
And so that's a very insightful point you make. It's good to always have that perspective when thinking about these things.
Yeah.
all right. So let's talk a little bit about the third theme that we'd like to explore on this podcast, and that's to do with globalization. Now, given with what's going on with geopolitics, especially the relationship between US and China, there's been a somewhat reversal of globalization, or at least decoupling, if you want to call it. One of the posts that you wrote mentioned the impact of Smoot-Hawley Tariff Act on the Great Depression. So, one, what can we learn from this policy mistake, and how can it inform discussions around trade policy and consequences today? Now, before you answer, I do want to just quickly tell our listeners that Smoot-Hawley Tariff Act was basically a bunch of protectionist trade policies that were put in place during the Hoover administration, if I'm not mistaken. And a lot of times it's considered as a precursor to the Great Depression, because trade plunged by, I think, about 67% around that time. Huge. And for more details, I would really encourage your listeners to go and listen to an episode on Smoot-Hawley trade tariffs on the podcast Planet Money. I think they covered it like about 4 or 5 years ago, but it was very well done. So if you want, and I'll probably put some the links in show notes as well. But yeah, Mark, why don't you?
So the Smoot-Hawley tariffs were an example of a broader issue, which you referenced, which was these tit for tat trade barriers that companies were putting up. And, the intent was they wanted to rescue their domestic economies, and they figured by protecting domestic production, they could exit the depression. Now, the problem was they would do these tit for tat responses, and it just caused global trade. It was called beggar thy neighbor policies, which you may have heard that term thrown around too. And it was a big factor in not only intensifying the Depression, but really causing World War II. And that's something that was really enlightening to me reading about history. Was it's not a coincidence that World War II happened, within 10 years of the Great Depression. It very much caused it, and especially with Japan. So Japan is a country that lacks natural resources, and they were heavily dependent on trade in order to get raw materials for their manufacturing and get food for their population. And when trade went off a cliff, they ran through their foreign exchange reserves, and their people started to starve. And the way they reacted was by first of all, they did a false flag operation in the South Manchuria Railway and invaded Manchuria, and then they invaded China, and then they ended up moving into Southeast Asia. And that was really, when you really step back, these trade battles were critical contributors to World War II. So the lesson is, I think, is I don't see us going back to that, by the way. I mean, at least not yet. I mean, we're not even close. But trade is important because it look, there are victims of it as well, but at the end of the day, it's the principle of comparative advantage, which is by everybody benefits by having people that whatever their best use of human resources is to focus on that product, and then produce a surplus and then trade with other nations. That increases the wealth of all nations. And the temptation when you're in difficult economic times is if you try to preserve just what's good for your nation, other nations can respond, and everyone goes down as a result. And that's a great lesson from Smoot-Hawley was one example of the beggar thy neighbor policies that really that led to a drop in global trade and contributed very heavily to the onset of World War II.
Awesome.
Does that answer your question? Or
Yeah, absolutely. And one, I mean, the extent of protectionist policies that were put in place. I remember that obviously when you put trade barriers, different congressmen would come and talk about, okay, let's protect the industries in my constituency or in my state, right? And everyone's trying to come up with something. In fact, it went, I would say, almost so ludicrous that they even put breeding goldfish in as one of those protectionist. Like you can't import the goldfish; you had to protect it because.
I don't know if that's a huge
Yes.
threat, but that's interesting.
Yeah, that was again. They reference it in Planet Money, so. I mean,
I remember reading that too. Yeah, the Battle of the Goldfish. That was fascinating.
It's a small thing that probably didn't affect the whole, but it just shows the mindset and the attitude was there back then. So, I mean, we're really looking forward to the bookmark, and
Thank you.
but one of the things I want to ask about. So, you've obviously done a lot of research, U.S. financial history. So, first of all, I mean, you've briefly touched a little bit already, but are there any recurring patterns or trends in U.S. financial history that you believe people or investors should be aware of? If so, could you provide some examples?
Yeah. So in the last chapter of the book, I outlined a bunch of trends that I thought were the most important. And I've kind of hinted on indirectly at one, but there's kind of I'm sure you've heard the saying before that history repeats, and I mean that's directionally correct, but it's actually what I have found is it's actually more of a combination. So things never repeat exactly, but they often you kind of piece together what's happening by taking different events throughout history, and I think the COVID pandemic is a great example. It's like if you look at that sudden shock at the beginning, that was actually very similar to no one saw World War I coming, And when it did, like everybody just went crazy. You know, everything just shut down. The New York Stock Exchange was closed for 5.5 months. And so that was very similar to just the complete like shock that the world had changed in March 2020. Then, you know, we talked about the inflation being similar to the end of World War One and the Great Influenza in 1919. And then the inflation, the Fed policies were actually similar to the policies in 1920, but it was really colored by them not wanting to repeat the inflation of the 1970s by making the same mistakes that they made in the late 1960s. So it was knowing it wasn't that everything repeated exactly. It was that you had to piece together which parts were relevant at which point in time. And history plays out a lot like that. It's not that something repeats exactly, it's that you have to know all the pieces. So that was that was probably the biggest thing. The second thing is investors just spend, and you know, I used to do this, so you know, I relate to it. They just spend so much time in the present, and a lot of that is noise, and they limit their knowledge to just their life experience, and by doing that, you miss a lot. And I just we're so biased toward that, and you know, I think expanding your mind and going back in time, it a lot of times is much more valuable than just kind of watching the news, because most of the news is, I really do believe it's mostly noise.
So,
And then, sorry, go ahead.
Go ahead. So, what would you say? You know, the sort of the latest sort of financial crisis that, you know, especially in the U.S. that happened was in, you know, 2008, 2009. Like, what would you say would have been some of the lessons there out of that event? And then, do you think, you know, where we're at now, and I can't say it's comparable to 2008, 2009 now, but do you think we've learned from some of those lessons, or similar to your previous comments that human behavior, you know, doesn't change a lot, and there's still things that, you know, maybe we haven't really taken from that latest sort of financial time in history?
Yeah. So so I don't think we've learned everything, but the 2008 2009 crisis, I mean, that was a legitimate event. You know, that was a big one. And what really happened, so the chapter I wrote on that, I call it the Great Shadow Bank Run. And what really happened was you had a huge shadow banking system that was lending short, borrowing short and lending long, and it didn't have the Fed as a lender of last resort. So, I mean, you saw that with the investment banks. You saw that in money market funds, essentially. You saw it in, it wasn't, AIG was just a mess. I mean, it was essentially just writing these insurance contracts with not enough reserves to back it. But so, you know, again, it revealed the danger of a shadow bank run. The other thing, the biggest lesson that I feel like we didn't learn from that event is there's a tendency of politicians and the media, when you have a major event like that, to just figure out who was the most guilty and focus a lot of blame on them. And the reality is, when you have a major financial crisis at that level, it's not a couple people that caused it. It's a systemic problem that involves a lot of people. And the way I laid out the chapter on the Great Shadow Bank Run is it's almost like a supply chain. And each one was making fundamental mistakes, but they didn't really see how it was playing out systemically. So you had the American population who, you know, thought real estate prices were going to go up forever, which they weren't. And, you know, there's this quote from this guy named David Loray, who was the head of the National Realtors Association. And he said, I think it was in like 2005, that we've never had a national crash of real estate prices in U.S. history, which is completely false. I mean, you had a horrible one in the 1820s, 1840s, 1930s. It's just not accurate. So you had, a lot of speculation on real estate. Then you had lenders who would just, make a loan. They just they were just motivated by volume. They would make a loan and they would pass it on to investment banks who would securitize it, sell it to money market funds, and everybody in the chain, they knew they were taking risks, but they didn't see the big picture. And I think that's what was probably lost to a lot of Americans, is that everyone blamed the investment banks, and they were guilty. Don't get me wrong. I mean, they were guilty of bad behavior, but it was much more systemic to that. And I think when you focus blame on one segment that was most guilty, you lose sight of the fact that there was a lot more to it. And sometimes it doesn't get addressed because it gets ignored.
Fascinating.
Yeah.
And again, while you were doing research, are there any lesser known aspects of financial history in US that you found quite fascinating or you think was overlooked?
Yeah. So I'm going to get my plug in here for Hetty Green, because I think it was the most interesting story that I came across. So I consider her the best investor in history. She lived.
What's her name again?
Hetty, you said Hetty Green.
Hetty Green, HTTY Green. I wrote an article on her in the Financial History magazine, which is published by the Museum of American Finance, and she was incredible. She was, a woman on Wall Street. She was really investing from 1870s to around 19. She died in 1916. And you'd have these periodic panics and crashes. She always saw them coming. She was extremely thrifty, and the way that she was portrayed, they used to call her the Witch of Wall Street, is entirely untrue. She was actually very generous. She was just, in the Gilded Age, people are throwing money around everywhere. She wasn't like that, and she was an incredible investor. And so the article I wrote in Financial History magazine just kind of outlines the traits that made her a great investor: her thrift, her patience, her persistence and skepticism. She was incredible.
Yes, I was going to actually ask. I've never even heard of her, and I'm
not surprised.
And she's female, and I'm fascinated now. I think I'm going to go down a rabbit hole and do all this research around her. Thank you, Mark.
Well, a lot of the stuff that's told about her is false. So read the article in Financial History magazine.
Okay.
I'm hoping it. I researched her a lot. I mean, I read every book I could find on her, and I researched her a lot. She was amazing.
So you called her interestingly enough, the Witch of Wall Street.
She was the Queen of Wall Street. The people on Wall Street.
Let's make her Queen of Wall Street.
Well, that's what they called her. The people on Wall Street called her the Queen of Wall Street.
Oh wow. What made her? I'm very curious. What made her the Queen of Wall Street? Like, what made her such a phenomenal investor?
So she was paid. If I had to pick the things that were most important, first of all, she was thrifty. So she hardly spent anything. So what people, not only does that enable you to accumulate wealth, what people really don't appreciate is it enables you to take advantage of dislocations, because you're the only one that has money, and you don't have to worry about any losses because your living expenses are nothing. So she was often a lender of last resort. Essentially, she was the only one. So J. Pierpont Morgan assembled people in the Panic of 1907. All the major financiers of Wall Street. 20 people in a room, and Hetty Green, and because she had a lot of cash, because she saw it coming, and so the thrift gave her the ability to be a capital provider in dislocated markets where you can make a lot of money. And she was just patient. She didn't care about her appearance. She didn't care about flipping an investment and making a lot of money in 6 months. She would buy things, hold them for a long time, and then sell when people were going nuts. And I'm probably a little all over the place in describing her, but at the end of the day, what really distinguished her in my mind was her thrift, her patience, and her ability to what really distinguished her is she would see the monetary currents going on. Like, she saw in 1905 that things were getting out of hand in terms of valuations. She saw after the earthquake that money was going out of New York, and she got ready for it, and that was pretty amazing.
That's very fascinating because, like, yeah, I mean, never even heard of her, right? So
Yeah, well, I'm hoping to change that. Every time I get a chance, I highlight her because she was true, and she had none of the advantages too. She couldn't sit on a corporate
No,
board.
no,
She couldn't be. She did it with like her hands tied behind her back, and she was incredible.
she couldn't get a mortgage back then or anything like that.
Yeah, she might have been
No?
able to do that. I don't
Oh, okay.
know, but she couldn't sit on a corporate board.
Okay.
She couldn't get a membership in the New York Stock Exchange. You know, what people don't understand too is before 1933 and 1934 with securities regulations in the United States, the name of the game on Wall Street was market manipulation and insider trading. And she couldn't, you would essentially form stock pools. That's another funny thing. So those meme stocks, when people are, that's market manipulation, and it's not new. That was like normal for like 100 years before 1930s. But she couldn't, no one would ask her to participate in those. So she didn't. That's how people made money, and she couldn't do that.
wow. Awesome. So, Mark, this has been a very fascinating discussion, and we're really looking forward to your book. So, do you want to talk a little bit more about that?
Sure. So the book, again, it comes out in February 2024. The manuscript is written. It's pretty long. It's about 31 chapters. It starts in 1790 with Alexander Hamilton's financial programs, which the two important things were he actually did start the first bank of the United States, which was the country's first central bank. And he also consolidated the debt and restored the credit of the United States, which is actually relevant to what's going on today. We haven't defaulted in 233 years, and Alexander Hamilton set that precedent. And then it goes through a lot of the major events, the evolution of Wall Street, the evolution of the US economy, major financial shocks like the Panic of 1907, World War I, World War II, the Great Inflation, really all of the major events that, at least my take on it, you need to understand the present. And it ends in 2023 with the Fed's battle with inflation.
Awesome. Yeah, I mean, for someone like myself who's interested in history in general and financial history for sure, I mean, I'm looking forward to it. There's some very interesting characters in U.S. history. Hamilton,
Yes.
you talked about consolidating the debts and what he had to negotiate at that time.
He was incredible. Hamilton
right?
was incredible.
Yeah, absolutely.
Yeah.
And even the negotiation around that time, because when they, because a lot of states were against it, that the federal government would have a lot of power, and how they, compromise on the location of the capital.
Yep.
Washington, D.C. today had a lot to do with it as well.
Yeah, it did. Yeah, you're right.
And Andrew Jackson was another interesting character who just wanted to pay off the entire U.S. debt and the cascading effect it had. So yeah, I'm really looking forward to the book, and hopefully, maybe we can have you back in the future again.
Oh yeah, definitely. I would love to have love to come back, and thank you for having me. And
actually, before you go, one of the things we do with all of our guests, we ask a couple of sort of what I would say fun questions. So one of the questions we like to ask is, what are you reading? Or is there a book that you would recommend to our listeners? And then the second one is, besides your own book, let's say, the second question is there something you're watching, whether you're streaming, is there a movie, a show that you're really into that you would also like to recommend?
It's funny. So I'll start with a show. I'm watching a show called The Foundation. It's an Isaac Asimov. I don't know what I'm streaming it. I don't know what it's. I think it's on Apple actually, and it's so funny because it's in the future, and there's this empire that there's this mathematician who figures out a way to use history to predict what's going to happen in the future, and he predicts that the empire is going to fall. And it's the whole story of how the empire tries to kill him, and then he gets exiled, and it's the whole story of using history to predict the future. So I thought it was just kind of funny that I didn't pick it for that reason. I just saw it on Apple. I thought it was pretty funny.
Very, very prescient of you.
Yeah, but if there's a fun book to read, there are two books that I think are fun, but important. The Great Crash by John Kenneth Galbraith is a good book to read. Oh, I think the question was what I'm reading right now. So believe it or not, I don't have a book I'm reading. Well, the last book I'm reading, it's not going to be interesting, is on publishing a book and marketing and stuff like that. But that's not interesting to readers. But I took a break. I can't tell you how many. I probably read to research this book 150, 200 books. I don't even know how. I can't even keep track of it anymore. But it gets a little tiring. So I'm not reading any financial history right now. I probably will, but pick it up again, but not right now.
So you would recommend the Galbraith book?
Yeah, John Kenneth Galbraith, The Great Crash. It's a quick read. I mean, it's only like 150 pages, and it goes through the crash of 1929 and the Great Depression. And the other one is Reminiscences of a Stock Operator, which was written in 1940 about, and you kind of understand how market manipulation, insider trading worked before the Securities Acts of 1933 and 1934.
Great.
Oh, another book. Sorry, one more. Actually, this is pretty important. The Great Inflation by, I forget, Robert Samuelson. The last name is Samuelson. But that's really important to understand what's happening today, and why the Fed is doing what they're doing to avoid what happened during the Great Inflation.
And maybe I have one last question just to cap it off. Now having sort of looked at everything from the 1800s until now, is there one major lesson in a statement you could leave with our readers to say, this is one of the biggest lessons I've learned looking at the financial history of the US?
The rarest financial event is one that hasn't happened before. You almost never see it. Everything. It's happened before.
Okay, that's good.
Awesome.
Right. Thank you very much.
All right. Have yourself a great day.
All right. Thank you both.
Thanks, Mark.
All right. Take care.